Welcome to Deloitte's Debriefs Tax webcast series in Asia Pacific. Our webcast today is from our Geography Update series and is titled 2023 Japan Tax Reform Proposals, International Tax Policy and Geopolitics. My name is David Bickle and I'm a tax partner based in our Tokyo office, and I have the pleasure of hosting the webinar today. I'm glad to say I have 5 speakers with me: Brian Douglas, Brian Mayer, Masaaki Miura, Nicole Baxter, and Fumiko Mizuguchi. Mizuguchi-san leads Deloitte's indirect tax practice here in Japan, which covers, of course, Japanese consumption tax, or JCT. And those of you who have worked with Mizuguchi-san before will, however, also know her as a Steuerberater, or licensed German tax accountant, which also gives her deep expertise in European VAT as well. And from Mizuguchi-san's team, I'm also very pleased that we also have Nicole Baxter with us here today as well. And Nicole is a senior manager, and her presence here today reflects the importance of indirect tax matters to today's conversation about the changing tax environment in Japan. Now, in addition to indirect tax, I'm pleased to say that we also have Miura-san on the panel, and Miura-san leads our GI3 practice in Tokyo, GI3 standing for Global Investment and Innovation Incentives. And lastly, I'm delighted that my other 2 colleagues participating today are from the same group as me, which is Business Tax Services, where Brian Douglas is a managing director and Brian Mayer is a senior manager. Now, all of us are based here in Japan, and we're not working from home. We're based in our Tokyo office. And if you'd like to see further details, you can access our bios at the left-hand side of your screen. Now, before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features on our webcast console. Firstly, all users are on listen-only mode. So if you do have any content-related questions, you can submit them at any time in the Q&A box at the bottom right of the screen, and we'll do our best to respond to your questions during the course of the presentation. Secondly, all PC users can maximize or minimize each box at their convenience during the webcast, and you may also explore the icons that you can find at the bottom of the screen. And if you want to download today's slides and related publications, please go to the Downloads and Links box. Alternatively, if you're on the move and viewing from a mobile device, you can see all of the slides on your screen and also respond to the survey questions as well. And thirdly and finally, if you require an attendance record for this event, you'll receive an automated email with CPE certificate after watching for 50 minutes, although we certainly hope you'll stay on for the full hour today. Okay, so let's turn to the theme of today's event and the topics that we're going to cover. As a reminder, the title of the session today is 2023 Japan Tax Reform Proposals, International Tax Policy and Geopolitics. And in terms of understanding the context of the proposals, I think it's helpful always to step back and take a look at the government's policy priorities to understand the context in which the proposals have been formulated. So going back 4 or 5 years, the content of the annual Japanese tax reform was very much driven by the policies of Prime Minister Shinzo Abe, in particular his growth strategy, which together with fiscal stimulus and aggressive monetary policy made up the 3 arrows of his signature approach to rejuvenating the Japanese economy, commonly known as Abenomics. Now, following his resignation, the new government did not deviate significantly from the policies of Abenomics, although the tax reform 2 years ago did reflect Prime Minister Suga's own policy priorities, which were shaped in part by the experience of COVID-19 and also an increasing focus on climate change. In particular, this manifested itself in the desire for more resilient systems of business operation, including digitization, cybersecurity, things like that, and also an economy that could grow sustainably into the future. After less than 1 year, though, Prime Minister Suga indicated his intention to resign, which heralded the government of the current Prime Minister, Fumio Kishida. Now, the policy priorities for Kishida-san are summed up in his desire for a so-called new capitalism. And in line with this, last year's tax reform, the first under his regime, combined the stated goals of contributing to a positive cycle of growth and wealth distribution with the development of a new society after COVID-19. But whilst the challenges of climate change, sustained pandemic recovery, and wealth distribution remain high on the list of the government's priorities, these have been joined in the geopolitical concerns of an increasingly volatile, uncertain, complex, and ambiguous world. Now, this includes matters of economic and also military security, and in particular the challenge of securing, not only securing, but also funding the resources necessary to deliver on plans for an effective response. So this was the context and the background against which the Japanese government has formulated the 2023 tax reform proposals. So looking to today's agenda then, we're going to begin with by looking at the need to fund new spending commitments. And as this need to fund new spending commitments looms large, we'll be looking at the messaging the government has been providing through the tax reform around changes or possible changes to tax rates. From there, we'll take a look at the tweaks the government is making to incentives designed to nudge corporate behavior in line with policy priorities. Firstly, we'll look at incentives for promoting regional future investment and digital transformation and carbon neutrality. And then we'll take a look at the incentives for increasing spend on research and development, R&D. Now, global challenges require global responses, and we'll then take a look at how Japan is reacting to the OECD rules aimed at tackling base erosion with respect to the digital economy. From there, we'll switch our focus from what is coming to very much what is here already, and look at the latest developments in connection with the two most pressing issues for persons who are responsible for Japanese taxes at the moment, which are electronic record retention and the forthcoming introduction of the qualified invoicing system. Now, these are important in that they will impact almost all taxpayers in Japan, and with the approach of related deadlines, these issues are now becoming increasingly urgent as well as not just important. And finally, we'll end by taking a look at tax considerations for e-commerce platforms. Now, details of this are scarce at the moment, but given the burgeoning volume of business transactions conducted over these online platforms and online marketplaces, this is certainly going to be a matter of considerable importance going forward. So let us begin then with the tax rates, and with just one final point of context. Raising tax rates, or particularly raising consumption tax rates, and in the case of consumption tax, to fund the demands of caring for an aging society, this has been part of the political debate in Japan for a number of years. But with Abenomics still fresh in the memory, and with Japan's business lobby advocating for income tax cuts to stimulate the economy, it was hard to believe just maybe 1 or 2 years ago that the government would now be seriously contemplating tax increases again. Now, this is in part underpinned by evidence that in spite of a very large increase in profits earned by Japan's biggest companies in recent years, over the past several years, tax cuts have not led to a material increase in the salaries of employees or a commensurate increase in investment. So it's harder now for the business lobby to argue for low taxation when the government faces an increasing range of geopolitical challenges and needs to fund its commitment to double defense expenditure annually from 1% to 2% of GDP, which involves an additional 5 trillion yen of spending each year, and that's about $33 billion. So that's the background. But in terms of what to expect and what's coming forward under the tax reforms, I'd like to bring you in, please, Brian Mayer. It'd be great if you can recap what's been announced and also what we can expect going forward.
Sure, David, and thanks for that helpful context. So, as you just mentioned, one of the longer-term goals of the government here is the strengthening of Japan's military capabilities. And of course, taxes would be an obvious source of financing in order to achieve these objectives. So on this point, one of the key takeaways from the 2023 reforms was that there's a clear intent to raise tax rates in the near future. And while the specific timing and details of the rate increases haven't yet been announced, what we can tell from the reform proposals is the government is expected to introduce some additional surtaxes from fiscal year 2024, and these would be levied on both corporate as well as income tax amounts. So if we can go to the next slide. So all indications from the reforms show that these will be surtaxes. So the additional tax would be calculated as a certain percentage of your tax liability and not on your taxable income. So for corporate tax purposes, it's estimated that this surtax percentage would be between 4 and 4.5%, with a 5 million yen deduction allowed from the tax base for small and medium-sized enterprises, or SMEs, as we call them here. And for income tax purposes, which would include individual income tax, as well as withholding tax imposed on certain payments made from Japan to non-residents, the surtax percentage would be 1%. This will, however, be accompanied by a corresponding 1% reduction in an existing surtax for reconstruction after the 2011 triple disasters here. And so the net impact for income tax would result in no change to the current rate, but only where the specific funds are being allocated within the government. So while these specific surtaxes that we see here haven't been encoded into the tax law as of right now, and aren't expected to go into effect until sometime in 2024, given their announcement in this year's reforms, I think it's prudent for companies to plan accordingly going forward. David?
Thanks for that, Brian. And I think the changing tax rates is certainly something that's going to remain high on the corporate agenda going forward. So with that, I'd like to turn next to incentives, and over to you, if I can, please, Miura-san, to update us on the measures for the promotion of regional future development, also digital transformation and carbon neutrality, please.
Yes, thank you, David. And the first incentive I would like to cover is the incentive for promoting regional future investment. This incentive was created as part of 2017 tax reform, which allows you to apply special depreciation or tax credit. Companies need to obtain an approval and confirmation on their business plan from the relevant prefecture and ministry, respectively. And according to the 2023 tax reform, it was announced that this incentive will be extended for 2 years. That is March 2025, with some revisions. I'm not going to the details in this session, but with regard to the eligible companies for this incentive, there is no change. All the companies filing a blue tax return can apply. However, due to the proposed revision in 2023 tax reform, which is tightened requirement, it is expected that the number of companies who can get a tax benefit of this incentive will be decreased. On the other hand, to encourage companies to make an investment, a new pattern of requirement to get additional tax benefit will be created. This revision is definitely favorable for certain high value adding companies. Next slide, please. Yes, one more slide, please. There will be no change to the type of eligible investment and tax benefits. Based on our experience, this incentive is used when a company is making an investment, such as building a new factory or new production lines. So that is all for the regional future investment. And the next is a tax incentive for promoting digital transformation. It was created in the 2021 tax reform. In the 2023 tax reform, it is said this incentive will be extended for 2 years with some revisions. Like the previous incentive, all the companies filing a blue tax return can apply. However, unfortunately, the new revision makes it difficult for the Japanese subsidiaries of inbound companies to apply for this incentive. The tax reform mentioned that a new requirement to increase sales outside of Japan as a result of DX investment will be newly created. Since many of the Japanese subsidiaries try to increase their sales from Japan market, it is assumed that this new requirement will be a hurdle in applying for this incentive. So the last one, next slide, please. Thank you. I would like to explain tax incentive for promoting investment for carbon neutrality. This is not subject to the 2023 tax reform, but we believe it is worth mentioning because it is widely used for those companies who set a goal being carbon neutral and plan to make an investment for decarbonization. Like DX tax incentive, this incentive was created in the 2021 tax reform. Certified companies can choose either a special depreciation or a tax credit. Yes, next slide, please. Thank you. So based on our research, this incentive is used by both large and small companies, and there are already about 80 certified cases. Specifically, to give you some examples, we observed that 1, highly efficient production equipment, 2, solar power equipment, and 3, storage batteries are certified under this tax incentive in the manufacturing industries. And while in non-manufacturing industries, 1, air conditioning equipment, and 2, energy management system are certified. So this incentive will be expired by the end of March 2024 next year. In order to get tax benefit, you need to start using certified assets after a business plan is approved by a relevant minister. So back to you, David.
Yeah, and Masaki, it seems that for tax incentives for regional future development and carbon neutrality, these can be used by what we call inbound companies. So companies parented outside of Japan with Japanese subsidiaries. Do you know any cases where these kind of inbound companies have actually been certified?
Thank you for raising that question, David. For regional future tax incentives, it is certainly being used by the Japanese subsidiaries of inbound companies. However, for carbon neutrality tax incentive, we do not see any approved cases, unfortunately. But that being said, as long as the requirements are met, Japanese subsidiaries of inbound companies can also enjoy this incentive. So we recommend you to consider applying for it in case you have an investment plan for decarbonization in Japan.
Okay, well, thanks for that, Miura-san. And this brings us to our first polling question. And I apologize in advance that this polling question is really aimed at those listeners today who are working with inbound companies that I just mentioned, so groups which are parented overseas. But the question is, Why have your Japanese subsidiaries not applied for the carbon neutrality tax credit? And the possible answers are, is it because you have no eligible investment? Alternatively, have you tried, but you could not meet the requirements? Third option is you've considered this, but did not apply due to a lack of resources to make the actual application, or perhaps you simply didn't understand the option existed. We've got some initial results coming in, but I think as these continue to come in, Miura-san, we'll give it a few more seconds. Maybe you could just touch on where Japan is at the moment and its push for carbon neutrality.
Yeah, sure, David, thank you. So in 2021, Japanese government set their goal to be carbon neutral by 2050. In order to achieve it, the government have created special measures, not only tax incentives, but also non-tax incentives such as cash grants and interest subsidies. In 2023, with the purpose of promoting the investment from private sectors, the government decided to issue Green Economy Transition Bond, and it will be a source of funding to create additional measures. Like other countries, we expect that new incentives will be come out in the near future. So we recommend you to keep paying attention to the development, especially if you have a plan to make an investment into Japan.
Okay, thanks for that, Masaki. And looking at the results, and we can see on screen, unfortunately, there is no one has actually tried to make the investment at the moment, but it does seem that perhaps this is a positive thing, that there's still a number of businesses that weren't actually aware of the possibility. So hopefully going forward, more and more companies will understand that this incentive does exist, it's a real benefit, and will be able to consider whether it's worthwhile them trying to apply it in their own particular case. So hopefully there's some scope for a greater uptake on this particular incentive going forward. Okay, so with that, thank you very much, Miura-san. And I'd like us to pivot now to one last type of investment incentive, and this was in relation to R&D tax credits. Brian Mayer, if I could bring you back in to talk us through this, please.
Yeah, sure. So as you mentioned, another measure the government is trying to use to achieve its policy goals here is the R&D tax credit regime. So the new revisions proposed in the most recent tax reform are actually set to offer a greater benefit for those taxpayers who are increasing their spending on R&D. But at the same time, the proposed revisions will actually reduce the benefit available for companies who are spending less on R&D compared to previous years. So this is perhaps better explained visually, as we can see on the graph here. So on the horizontal axis, we have the percentage increase or decrease in R&D expense compared to prior years. And then on the vertical axis, we have the percentage of R&D expenses, which can be credited against your corporate tax liability. So considering this relationship, if we look at the blue line on the graph, so this shows this relationship under the proposed revisions. And we see the green line, which is this relationship under the current R&D tax credit regime. We can see that the slope is obviously steeper under the new rules, essentially meaning that a larger percentage of R&D expenses can be credited for the same corresponding percentage increase over prior years compared to the current system, while at the same time, a lower percentage of expenses are creditable for the same percentage decrease in R&D spending compared to prior years.
Yeah, and Brian, when you refer to percentage of R&D expenditure increase or decrease compared to prior years, Are we talking about a year-on-year comparison?
Yeah, so that's a good question. The percentage increase or decrease, which we're talking about here, is calculated with reference to average annual R&D expenses over the previous 3 years. And this will remain the case under the new proposed rules as well. So it's not a simple manner of just increasing R&D spending compared to your prior year. But if companies have, for example, scaled back a bit on R&D in the immediate post-COVID years, this could be a good opportunity to realize some more tax cash savings out of the R&D credit if your R&D expense is set to rise in the near future. And just one final point I'd like to touch on with the R&D credit. I'll also note that the mechanism for determining the credit limit is set to change under the tax reform. So under the current rules, the cap has been set at a certain percentage of your corporate tax liability, generally 25%. But a new range type system will be implemented where the credit limit can be increased further with a larger R&D investment, which is actually in line with the overall theme of this year's revisions, that a larger R&D investment compared to prior years will result in greater benefits for you. So that's it for me on R&D. Back to you, David.
Okay, thanks very much for that, Brian. So pivoting away from domestic incentives and into the international tax environment, the OECD and G20, Japan has decided to introduce the OECD G20's Inclusive Framework's GLOBE rules, where GLOBE stands for Global Anti-Base Erosion Rules, often referred to, and perhaps people are more familiar with this term, often referred to as Pillar 2. So Brian D., if I can bring you in here, please, could you take us through these proposals?
Sure. First, let me give a little context as to where Japan is with not only with respect to Pillar 2, but also the other big OECD Inclusive Framework initiative, which we refer to as Pillar 1. As a reminder, Pillar 1 is a set of rules aimed at reassigning taxing rights to market jurisdictions to deal with what some would argue as an inherent unfairness in the current international tax system as it relates to the digital economy. Whereas Pillar 2 is a set of rules that will impose a minimum of 15% tax on profits wherever those profits are earned. Now, regarding Pillar 1, Japan indicated in the 2022 tax reform that it would implement rules to deal with the digital economy in a future tax reform, but so far no specific rules are provided in the 2023 tax reform. However, Pillar 2, following the EU's announcement or agreement, Japan is also proposing to introduce certain elements of Pillar 2 in its tax reform. And specifically, it's the income inclusion rule, which allows the Japanese government to tax a Japanese entity on the low taxed profits of its foreign subsidiaries. And this will be implemented for years starting on or after the 1st of April 2024. Now, Japan is not yet introducing some of the other components of Pillar 2, such as the undertaxed profits rule or the qualified domestic minimum top-up tax rule, but it did indicate that it intends to do so in a future tax reform.
And the income inclusion rule, or the IIR, is clearly a rule that will impact, say, Japanese multinationals. But as many of our audience today are with what we call inbound, so they're not representing Japanese multinationals, representing foreign parented groups. What's going to be the impact for these non-Japanese multinationals, foreign parented groups?
Yeah, well, I think the answer to that is probably not too much. First of all, these rules will only apply to large multinational groups with revenue of 750 million euros or more. Second, even if a Japanese subsidiary belongs to such a group, in most cases, it will likely only need to file a notification to Japanese tax authorities and would not need to deal with the calculations and everything else that comes with the income inclusion rule, at least not in Japan. However, there are some limited situations in which the Japanese income inclusion rules could apply to a Japanese subsidiary of a foreign multinational group, and we'll talk about those in a moment. But first, let me discuss about the information reporting requirements I just mentioned. So a Japanese entity, in principle, is required to e-file in English an information return within 15 or 18 months after the end of its fiscal year. And this information should include things like the name of the constituent entities of the group, the effective tax rate per country, and the global minimum tax amount calculated. However, the Japanese entity will be exempt from this large information return filing if the taxing authority in the jurisdiction of its ultimate parent entity can provide the Japan tax authority with that information. However, in this case, the Japanese subsidiary would still need to file a notification with the tax authorities, and this requirement would begin for fiscal years, again, starting on or after the 1st of April, 2024.
And this sounds very similar to the ultimate parent entity notification, or UPEN, form that Japanese subsidiaries currently file with respect to their country-by-country reporting requirements.
Yes, exactly. And I think we're expecting a similar impact in that Japanese entities will only need to file this notification indicating that its parent company is providing all the necessary information that the Japanese tax authorities could get from the other taxing jurisdiction. Now, if we can move on to situations where the income inclusion rule might apply to a Japanese subsidiary, there are two that we're considering here. And one is where the Japanese subsidiary is considered a partially owned parent entity, or POPE, and the other is where the jurisdiction of the ultimate parent entity does not impose an income inclusion rule, and the Japan subsidiary is considered an intermediate parent entity. Now, please note, in both of these scenarios, the Japanese entity needs to hold an interest in another group entity for there to be any consequence of the income inclusion rules. Now, in the case of the partially owned parent entity scenario, the income inclusion rule should be applied at the level of the POPE, the Japan entity, in scenario one. So if a foreign multinational has less than an 80% ownership of the Japan group company, which is included in the foreign multinational's consolidated reporting, and that Japanese company owns an interest in another group company, as shown on the diagram, well, then the income inclusion rule is going to apply in Japan to the partially owned parent entity. Now, in scenario two, in the case of an intermediate parent entity, the income inclusion rule will apply at the intermediate parent entity level only when all jurisdictions of the ultimate parent entity and any entity between the Japan company and the ultimate parent entity, as long as they don't provide or impose an income inclusion rule, then the income inclusion rule is going to be applied in Japan under this scenario two. Now, in cases where the income inclusion rule does apply, well, the company needs to start considering a couple of things. First of all, understand the Japan rules, and we expect a lot more details to come out over the coming months, but don't expect that Japan will deviate much from the guidance that's already been provided by the OECD. Right? Companies will need to collect and analyze information from various foreign subsidiaries, and if there are many, companies are going to want to find some tools to standardize information collection and to process that information efficiently. And then finally, companies will need to be able to report their income inclusion rule calculations and information. And these would be in effect for years starting on or after, again, 1st of April, 2024. And given there's a 18-month lag until any top-up tax is required to be paid, if we're talking about a calendar year company, the first payments should start coming due in June 2027. David?
Okay, thanks very much for that, Brian. Now, as I said at the beginning, I'd like us to pivot from discussions of what's to come in the future to some of the issues that are covered in the tax reform, which are very much about the here and now, specifically in relation to the requirements of the electronic record retention law and also to qualified invoicing, given the importance of both of this and the increasing urgency as deadlines to implementation get closer and closer. So for the first of those, the ERRL, or the Electronic Record Retention Law, Brian Mayer, Brian M., if I can bring you back in here, please. Could you just recap on where we are currently and what changes have been announced in the 2023 proposals in relation to this point?
Sure. So electronic document retention has certainly been a topic on the minds of many of our clients in recent times, especially given the impacts of the tax reforms in the past couple of years and the overall push by the government for digitalization in this space. So since the most recent tax reforms also included some tweaks to the Electronic Record Retention Law, or the ERRL, I'd like to spend the next couple of minutes highlighting some of those key updates, as well as remind everyone of the overall impacts of the ERRL from the 1st of January, 2024. So if you've joined any of our recent debriefs on tax reform, you might be familiar with this slide here, which shows the scope of Japan's ERRL. So just as a reminder, books and records for these purposes are separated into 4 categories, with the requirements for proper electronic retention differing a little bit amongst the different categories of records. But of particular note for today's purposes are what we call electronic transaction records, which we can see highlighted in the red box on the right side of the screen. So we're currently in a bit of a grace period for electronic transaction records, but from the 1st of January 2024, these will be required to be stored digitally in line with the specific requirements of the ERRL. So this would include, for example, invoices, contracts that have been exchanged in PDF or over email or exchanged in some other digital format. And I should also note that the other types of documents, which we can see highlighted in the yellow box towards the left, these are still eligible to be stored in hard copy and be considered as valid documents for tax purposes. And this will be the case even after January 1st of next year. So with that in mind, I'd like to focus today's discussion on the electronic transaction records.
And thanks for that, Brian. But just before we get into discussion of the details of this year's tax reform proposals, can you just remind us of who is eligible for this grace period that you mentioned and what specifically this grace period refers to?
Sure. So the grace period I mentioned was part of some transitional measures which were introduced in last year's tax reform. And this allows taxpayers with quote unquote unavoidable circumstances, basically until 1st January 2024, to begin storing electronic transaction records in line with the ERRL. So given that unavoidable circumstances has in practice been rather widely interpreted, this essentially provided taxpayers who were still making preparations to align with the law a bit of a grace period until the end of this year. But the most recent tax reform has made clear that these transitional measures are set to expire on December 31st of this year. But that being said, taxpayers who are still unable to comply by the end of this year may still be eligible for an additional grace measure if two conditions are met. So first, the tax authority would need to recognize that reasonable circumstances exist which prevent the taxpayer from storing electronic transaction records properly. And secondly, the taxpayer needs to be able to provide these documents upon request in hard copy to the tax authority in a timely manner. But at the current stage, it's a bit unclear how strict or lenient the tax authority might be with this additional grace measure. And given the limited amount of time remaining before the end of this year, we're certainly recommending to our clients to make appropriate preparations to be able to store these electronic transaction records properly by the end of this year. And just one other note on electronic transaction records from this year's reforms. So the requirements for storing these types of documents have been relaxed a little bit. So we can see on the right two columns on the screen here, where specific search function capabilities would no longer be required. So there's two cases where this would be applicable. The first is where a taxpayer is able to provide documents to the tax authority in hard copy upon request and organized by the date of the transaction. In that case, you would not need the specific search function requirements. And also in the case where a taxpayer has 50 million Japanese yen or less of taxable sales, those types of taxpayers would also not be subject to the search function requirements. So they have been relaxed a little bit in this year's reforms. So that's it for me on the ERL. I'll hand it back to you, David.
Thanks very much for that, Brian. Now we come to the issue which is rapidly rising to the top of the tax agenda here in Japan, and that is the introduction of qualified invoicing in connection with Japan's consumption tax regime. So I'd like to bring you in here, please, Nicole. I know your indirect tax team has been doing a lot of work with businesses, taxpayers in Japan, helping them to understand what they need to do to determine their readiness for these changes. Maybe if you could just give us a quick overview of where we are with the government's plans to bring these changes in and implement them this year, and also let us know what the tweaks are that the government has made in the 2023 tax reform in relation to the introduction of qualified invoicing or QI.
Thanks, David. So as many of our listeners will be aware, Japan will introduce from 1 October this year the Qualified Invoice System, which does actually share some similarities with the VAT and GST invoice systems. So as the go-live date fast approaches, the number of businesses still yet to register under the new system has been quite concerning. So after assessing the situation over the course of last year, the government has now announced additional transitional measures that you alluded to in the most recent tax reform, to which may provide some relief for those businesses still trying to transition to the new rules. So just by way of reminder for everyone, before we get into the details, after the introduction of the Qualified Invoice System, the taxpayers need to retain qualified invoices to take an input JCT deduction. And also, only a taxpayer registered as a qualified invoice issuer can issue a qualified invoice. So to register as a qualified invoice issuer with an effective date of 1 October, the taxpayers initially needed to submit a registration application to the tax authorities by March 31. However, the Japan tax authorities actually announced that applications which will be submitted after that deadline will now be accepted, and the qualified invoice registration number will be effective from October 1, 23.
And Nicole, if I can just interrupt you for a second there. As a result of that announcement, does that mean taxpayers can submit a registration application on, say, 30th of September and still be registered as a qualified invoice issuer the next day on 1st of October?
So yes, in theory, if the taxpayers file an application before September 30, their effective date of registration will be 1 October. But we understand from the Ministry of Finance that registrations are taking anywhere between 3 to 8 weeks to approve. So actually, for those taxpayers that register, say, after July, we expect that they will not have received their qualified invoice number by 1 October. I'll get to why that's important in a second, but before I do, I'd just like to discuss one of the proposed changes announced in this tax reform, which is to actually extend the registration period. So prior to last week's announcement that I just mentioned, for those taxpayers that register between April and November, they will not be registered as a qualified invoice issuer until the beginning of the next tax period. For those taxpayers that use the calendar year as their fiscal year, their qualified invoice registration number will only be effective from 1 January 2024. However, under the proposed measure, this registration period will actually be extended to the middle of December. So what this means is that the taxpayers will be able to submit a registration application until the middle of December and still be registered as a qualified invoice issuer by 1 January. But in light of the announcement, this really only now applies to those taxpayers that apply after 1 October.
Yeah, and given this rather long registration period, it seems as though the government is trying to offer an opportunity for taxpayers still trying to catch up.
Yeah, so that's right, and there's always a but, only those taxpayers that submit a registration application prior to March 31 officially, and those that submit an application, say, before July unofficially, will actually be in a position to issue a qualified invoice come 1 October. So without getting too technical, the taxpayers are actually required to show their qualified invoice number on the qualified invoice. So this number is issued only once the application has been approved. So David, even though the registration period has been extended, we are strongly encouraging all taxpayers who are yet to register to focus their efforts on submitting a registration application before March 31 in order to ensure that they can issue compliant invoices on 1 October.
And Nicole, can you just highlight one more time why that is an important point for taxpayers?
So from a very high level, as a supplier, if you're not in a position to issue qualified invoices to your registered customers, your goods and services are going to become 10% more expensive. Then as a buyer, you really need to know which vendors in the supply chain are not qualified invoice issuers, as this will affect your ability to deduct input JCT, which could then have an impact on your JCT cash liability. So as you can see, David, the extension in theory may seem helpful, but it's still necessary that the taxpayers submit a registration application before March 31. But just one last point on registration before we move on, and this is important for those enterprises which intend to become a JCT taxpayer and register as a qualified invoice issuer on or after the 2nd of October. They can actually nominate a desired effective date of registration, provided that the date is at least 15 days after the application submission date. So, for example, as you can see from the slide, if the enterprise wishes to become a JCT taxpayer and register as a qualified invoice issuer by the 17th of October, a registration application needs to be submitted no later than the 2nd of October.
Okay, thank you very much for that, Nicole. And before we continue on with some of the other tax reform measures, I'd just like to invite our audience once again to share their thoughts in relation to this polling question. And the question this time is, has your business submitted a qualified invoice registration applications? And the possible answers are yes, which means you're very well advanced and doing everything on time, or quite possibly the second answer being no. And is that because you're unsure what needs to be done to ensure readiness for QI? Or is it no because no, but the application is currently under preparation by yourselves? Or lastly, is it no because you've actually decided not to register as a qualified invoice issuer? So hopefully people will provide their input to those questions, and it'll take a few moments, Nicole, for those answers to come in. And whilst we wait, can you just take us through some of the other ways in which taxpayers have been preparing, or ways that you have seen taxpayers are preparing for the introduction of QI?
Yes, so before I do, I think it's important just to remind the audience today that although it is a tax law change that is the trigger for the qualified invoice system, it's actually going to be teams like accounting, IT, and legal who need to take notice and address the impact. So while it is very important to register, that is really only the first step in the taxpayer's successful transition to the qualified invoice system. Some clients, depending on their operations, may need to modify IT systems and processes, update accounting procedures and policies, maybe even review contracts that might span the implementation date. And some companies may even need to upskill staff that, don't sit in Japan, and maybe sit in a centralized tax function in Europe or the US.
Yeah, thanks for that, Nicole. All very important points from a practical perspective for companies to be looking at. Okay, so we can all see on screen the results of the survey, and well, it's good to see that more than 1/3 of attendees today have already registered for QI. That still leaves 2/3 though, which are unregistered, and perhaps a little bit concerning is 28% are still unsure what needs to be done. So I think the message is that there is still time to become ready, but this is an important issue which probably does warrant management time on this now to consider how best to be prepared when the changes come into force later this year. Okay, so Nicole, just coming back to you, there were a couple of other, or one other JCT related tax reform I wanted to cover. And in particular, this is the announcements in the proposals to deal with, or rather assisting, what we refer to as exempt businesses. Can you just recap on what's there for these exempt businesses?
Sure, yeah. And just before I do, just to clarify, when you say tax-exempt businesses, we are talking here about businesses which supply goods and services that under the JCT law are subject to consumption tax, but the small size of the business means that they're not actually obliged to report consumption tax by filing a return or to remit the consumption tax to the tax authorities. So just to put this into context, there are currently 6 million businesses and 2.3 million tax-exempt businesses, so roughly 40%. So as you can see, the number of tax-exempt businesses is quite substantial. So the first point to note for these businesses is that under the qualified invoice system, they actually won't be able to issue a qualified invoice. So consequently, the purchaser will not be able to deduct Japanese consumption tax, which will increase the overall purchase costs. Secondly, at the moment, businesses which are purchasing these goods and services are entitled to take a deduction for input tax on these purchases. But after the introduction of the qualified invoice system, these purchasers will in principle no longer be able to take an input JCT deduction on these invoices from exempt suppliers.
So I guess it's less attractive then to purchase from these small businesses if it won't be possible to take an input JCT deduction.
Yeah, so that's right. And that's the reason that a transitional measure has been included in this tax reform that applies specifically to new consumption taxpayers, such as exempt businesses. So the measure essentially allows the would-be qualified invoice issuer to simply calculate their consumption tax liability as 20% of their output JCT. So in order to be eligible, exempt businesses must first file a notification to become a voluntary taxpayer and then subsequently apply to become a qualified invoice issuer between 1 October this year and 30 September 2026. So as you can see, this simplified calculation, it's really intended to reduce the overall compliance burden that comes with being a qualified invoice issuer, which seems to be the underlying theme of these measures. And more importantly, it will reduce the cash tax impact on those consumption taxpayers remitting Japanese consumption tax to the authorities for the first time. And just before we move on, as a side note, buyers, from their perspective, they should really get a sense check of whether their business is making significant purchases from these Japanese consumption tax exempt businesses to understand the extent, if any, of the adverse financial impact. So there's just one more measure that I'd like to briefly talk about.
John, I think this is one for small and medium-sized businesses, SMEs?
Yes, that's correct. So as we've mentioned a number of times today, the taxpayers are required to retain qualified invoices in addition to accounting books and records to substantiate their input tax deduction. So under the announced measures, eligible taxpayers will not be required to retain qualified invoices to claim an input tax deduction for taxable purchases of less than 10,000 yen. Instead, they will be able to make a claim similarly to how they currently do by retaining relevant accounting books and records only. So those eligible businesses are those with taxable sales of 100 million yen or less in the base period, which is the second prior fiscal year, or 50 million yen or less during the specified period, which is the first 6 months of the previous fiscal year.
Okay, well, thanks very much for that, Nicole. And I think that's a good point at which to wrap our coverage of qualified invoicing. And I'd just like to very briefly take a look at one more measure related to JCT, which crops up in the tax reform proposals. And Ms. Oguchi-san, thank you. Thank you for being very patient. Apologies that I noticed your name wasn't on our list of speakers at the beginning of the bio. So thank you. I'm glad you're still here, because this is a really important change, I think, coming up in the years to come. So I know that not much detail has been provided yet, but nonetheless, this is a measure that could have a significant impact for online e-commerce marketplaces.
Yes, David. It is called the Platform Taxation for Marketplace Facilitator Obligations, as it is referred in other jurisdictions. And the Liberal Democratic Party tax proposals, the Ministry of Finance expressed its intention to study this topic in more detail during the next fiscal year. So far, the extent of the obligations to be imposed on marketplaces is unclear, and no implementation date has been provided. To Deloitte's knowledge, the Ministry of Finance intends to target foreign sellers providing digital services such as online games via platforms in order to reduce the non-taxation of these types of sales. It's also worth mentioning, David, that currently marketplaces can actually be appointed as a tax representative already for online sellers in relation to their JCT obligations. And from October 1st this year, the marketplace can also be appointed by the Japan Customs authorities to act as the online seller's attorney for the customs procedures. Additionally, online sellers are required to give details about the associated marketplace in their customs declarations. That's a change.
Yeah, thanks very much for that, Mizuguchi-san. And this is clearly something that we'll be having to keep a very close watch on as the situation develops in the months and the years to come. Okay, well, thank you. And look, that brings us to the end of our content today, right at the top of the hour. Perhaps unsurprisingly, though, we have had quite a few questions coming in relation to qualified invoicing. As I say, the deadlines for this are approaching fast, and there's still some uncertainty about what's required. So just before we wrap today, Nicole, can I just bring you back in with a couple of what I hope are just quick fire questions, and we'll just try and, I've got three here and we'll just try and cover these, and I think they're brief. So firstly, someone's asking, will I be subject to penalties? The penalty regime, will I be subject to penalties if I am a JCT taxpayer and I do not register as a QI issuer by the 31st of March?
No, you will not.
Oh, that's a good answer, short and sweet. Okay.
Keep it short, yep.
Thank you. Next question. Do I need to issue qualified invoices to consumers? So I guess we're talking about like the end user here.
Again, no. So qualified invoice issuers are only obliged to issue qualified invoices to JCT taxpayers.
Okay, and just last one in this bucket of QI questions, slightly longer. If I'm a registered foreign digital service supplier providing B2C digital services to Japanese business customers, do I need to register as a QI issuer so my business customers can continue to claim an input JCT deduction after the 1st of October?
Mm-hmm. So if you're still registered as a foreign digital service supplier as of 1 September this year, you'll actually automatically become a qualified invoice issuer from 1 October. So your customers will still be able to take an input tax deduction provided you issue them with a qualified invoice.
Okay. Well, thank you for that. That was some quick fire questions on QI, but unfortunately that is all we have time for today. So thank you very much, Brian D, Brian M, Miura-san, Nicole, and also Mizuguchi-san. And a special thanks to everybody out there who joined us today in our audience. We'd very much like to encourage you to fill out the survey that will pop up on your screen momentarily and let us know what you thought about today's webcast. If you did join us late, please note that this presentation will be archived online for future viewing. And if you feel that others would benefit from watching the webinar, please do share the webcast using the share this icon, or alternatively have them visit the Deloitte Debriefs webcast after this session. And for those of you that did submit questions, we will respond to all the questions submitted today over the next couple of weeks. Also, if you do think of any other questions or anything you'd like to speak to us about, please do not hesitate to reach out either to me or to one of our other speakers, and we will be delighted to hear from you and to respond as best we can. So at last, from all of us here at Deloitte, thank you very much for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.